What if the CEOs who delivered the biggest long-term returns to investors weren't the loud visionaries we celebrate, but the quiet capital rebels hiding in plain sight? This isn't a theory. It's the proven result of 8 CEOs. A single dollar invested in their companies grew to over $200, while the S&P 500, the main US stock market index, turned that same dollar into only 8, a 25-fold advantage. Their secret wasn't charisma. It was a ruthless discipline in how they used money. And that discipline is your key to spotting the masters of compounding wealth. The first group were masters of the buyback. They believed the best investment was often in their own company. Henry Singleton of Teledyne used profits to buy massive amounts of his own company's stock when it was cheap, quietly guaranteeing every remaining owner a larger share of the profits. Bill Stieritz at Ralston Purina, the pet food company, sold off underperforming brands and factories and used the cash to buy back shares only when the math was undeniable. Bill Anders at General Dynamics sold off unprofitable parts of the defense contractor, returned billions in cash directly to shareholders, and focused only on the safest, most profitable government contracts. The lesson is clear. Watch for leaders who would rather return your money than waste it on ego projects. The second group were patient hunters. They sat on cash, waiting for a perfect deal. Tom Murphy of Capital Cities kept his small media company lean and cash-rich for years. Then he struck, buying the much larger ABC television network and shocking the industry. Katharine Graham of The Washington Post faced constant pressure to expand recklessly, but refused. She invested only in ventures where the profits were guaranteed, protecting the paper's independence while multiplying its worth. Their lesson for investors is simple. Favor leaders who have the patience to do nothing until a golden opportunity appears. The third group were financial engineers. They used smart debt and tax strategies as fuel. John Malone of TCI used careful borrowing and legal tax strategies to buy up local cable companies, building the largest US cable network at its peak. Dick Smith of General Cinema quietly turned a movie theater chain into a diversified powerhouse by shrewdly investing in soft drink bottling and retail. They proved that how you fund growth is just as important as the growth itself. Look for managers who use debt as a careful tool, not a reckless gamble. And finally, the ultimate example. Warren Buffett of Berkshire Hathaway, who used every tool you've just seen. He bought wonderful whole businesses at fair prices, repurchased his own company stock when it was cheap, and waited decades for rare acquisitions that met his strict standards. Buffett is proof that this mindset isn't a niche trick. It's the ultimate blueprint. Patient capital allocation beats impulsive excitement every time. Across industries and decades, these CEOs shared a quiet code. See the company's money as shareholder money. Ignore short-term noise and quarterly headlines. Act only when the math is overwhelming. Repeat, for years. They proved you don't need a famous name or a trendy product to win. So who do you want managing your savings? A charismatic talker who chases the spotlight? Or a quiet calculator who compounds wealth in the background? This story comes from The Outsiders by William Thorndike, a book that reveals how 8 unconventional CEOs rewrote the rules of business success and offers a playbook for anyone who wants to invest with the same long-term edge.